Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin this hour with investors searching for direction in a pivotal year potentially for the Federal Reserve. Fed Governor Miran doubling down on his dovish stance, calling for the central bank to cut interest rates by more than a percentage point in 2026. Governor Miran joins us now for more. Governor, good morning and Happy New Year.
Happy New Year. Thanks for having me back.
It's good to see you. You've been very, very transparent about where you are on the dot plot and what your forecast is. So let's start there. Where are you for this year? Where's your dot? What are you looking for?
Yeah, so I'm unsurprisingly the lowest dot. I'm looking for about 1.5 points of cuts. A lot of that is driven by my view of inflation. I gave a speech about this about a month ago in December at Columbia University. My view is that almost all of the excess inflation over target is due to quirks of how we calculate inflation. So as you have talked about with many of your guests many times before, shelter inflation really, really lags a lot. And because average tenant rents have caught up to new tenant rents, because market rents have been running at a 1% rate for a couple of years now, I think it's appropriate to sort of think about underlying inflation as abstracting from that a little bit. The shelter inflation is indicative of a supply-demand imbalance from 2022 to 2023, not 2027. We need to be making policy for 2027 because of policy lags. And the other side of it is the portfolio management fees that I'm sure you've talked about again with many of your guests many times. Stock market went up, mechanically inflation moves higher, despite many of your other guests, I'm sure no doubt, telling you about fee compression in the asset management industry for decades. So you abstract from those two things, underlying inflation is running at 2.3%. That's within the noise of our target.
That sounds like an argument for neutral. You're making an argument, though, for this year, for accommodation. Where does that come from? Why are you looking for accommodative monetary policy stance coming out of Washington?
Yeah, so a couple things. First of all, as I just said, underlying inflation is running within noise of our target, and that's a good indication of where overall inflation is going to be going in the medium term. But then the unemployment rate is 4.6%, right? So that means that there's about 1 million Americans who don't have jobs, who could have jobs without causing unwanted inflation, without causing unwanted upward pressure on inflation. I don't think it's right to tell those people that they shouldn't have jobs because we're just mechanically calculating inflation in some silly way. I just don't think that makes a lot of sense. The other thing is that because we've kept policy tighter than I think it ought to be, that makes me mark down our growth forecast for the future relative to where it should be. And so if we hadn't been keeping policy, in my view, too tight over the last year or so, it wouldn't be necessary to provide that type of accommodation.
Just quickly, you say mark down in the future because the Fed actually marked up GDP for 26. Where do you mean in the future?
No, so like when you look at these dots, right, in the SEP, they're projections of appropriate policy and projections of economic fundamentals like growth and inflation, conditional upon appropriate policy. So my projections for growth and inflation are conditional upon getting my policy forecast, right? My policy projection. If I don't get my policy projection because the rest of the committee is more hawkish than I am, then we wouldn't meet my growth and inflation projections, we'd underperform them. And so because policy has been, in my view, too tight for the last year, that means that my expectations of growth will ultimately be unsatisfied because we didn't get the policy that I wanted.
You have GDP 2.6% roughly over the next few years. Are you saying that the appropriate growth rate is something like that 2% and 2.6% and not necessarily 3% or above?
Well, so that's conditional upon getting the policy projection that I want, right? And I think part of that is and so part of the reason why it's a little bit lower than I think 2.8, 2.9 is probably more where it would be if we sort of had the rate policy the entire time. Part of the reason it's a little bit lower than that is because we got to account for policy having been too tight over the last 12 months. Right.
There's also a question about the reaction function. We've been talking about the data that we're going to be getting tomorrow. What would you have to see to change your view? I mean, if we saw, let's say, the unemployment rate go down to 4.4%, would you start to question whether 150 basis points of cuts is really necessary this year?
That's a great question. And before I answer it, let me step back a foot and say that my forecast is conditional upon shelter inflation coming down, right? And there's people who agree with me, by the way. Like you look at the research from Goldman Sachs, it's pretty similar to where I am on shelter. They've got shelter inflation running below the pre-COVID rate by the end of the year, similar to where I have it. Where I differ from a lot of my colleagues, again, is thinking that goods inflation is not being driven by tariffs. I don't see tariffs being driven by goods inflation. I see goods inflation, I'm not sure what's driving it. I listed a few possibilities in the speech in December. I think the jury's still out on that one. But if I end up being right on inflation and on shelter, if I end up being right on shelter and Goldman ends up being right on shelter, and I end up being wrong on tariffs and everybody else is right on tariffs, then we're going to undershoot our target. Two-sided risk is back. And I think that people haven't really internalized that yet. And I think it's important to appreciate that. Now, where would I be wrong? Because so much of my disinflation forecast is based upon shelter. I'm going to be wrong if market rents pick up again.
So you're saying this is all an inflation issue and not anything to do with the labor market?
No, as I said before, unemployment is somewhat above somewhat above where I view the natural rate. And so it's 60 basis points, 1 million people, of unnecessary unemployment that we could reduce by having a more appropriate policy stance.
But to Lisa's point, is there a line in the sand on the unemployment rate tomorrow that would maybe have you think about this a little bit differently? What if the unemployment rate drops down 4.5% or even 4.4%?
Yeah, I would absolutely adjust my projection. So if you look at the September SEP, right, I was 50 basis points higher than I was in the December SEP. Part of the reason why I adjusted my dot down by 50 basis points is because the labor market didn't perform per my expectations that I had in September, and because inflation actually outperformed to the downside, right? So it was appropriate to adjust my dot down. And then on top of that, we had the two type policies I described. So if the data come in a little bit better, yeah, of course I'm going to adjust my expectation.
In just the past few weeks, we've heard from a number of your colleagues talking about how actually they feel like we're pretty close to neutral. Have you made any inroads convincing them that they're not right about this? The way you see the world?
I can't speak for them, but I think that every month we come in and the unemployment rate ticks up a little bit, and the inflation data sort of seem to be doing a little bit better. I think it's really difficult to argue that policy is neutral, especially when we've been on this course of gradual loosening of the labor market for a couple of years now. It's just really difficult in my mind to sort of argue that policy is not restricting the economy.
A couple of words I want to pick out, and one is neutral and the other is correct. I think it's very difficult to say this is where I think neutral is and this should be the correct policy rate, because it's such a guessing game as to where neutral is, and I think you understand that, of course. I also want to pick up the difference between being an economist and being a policymaker. When you say two-way risk, I think that really makes us all think about speed and the appropriate speed to adjust monetary policy when there is two-sided risk. Why do you think we should be going this fast this year, in your mind, to cut that aggressively in 2026?
Sure. So the same thing as I said in the last few times I've been here. We're still materially above neutral in my mind, and there's not really a reason to be materially above neutral if the labor market is in a weakening path and inflation is underlying inflation's already running close to our target and on trajectory to hit the target. There's just not a real reason to be so restrictive, and we're running unnecessary risks on the labor market by being so restrictive. And so in my mind, it's like we're selling options for nothing, and I don't see why we're selling those options for nothing.
This just requires such a strong amount of conviction, though. Coming out of the pandemic, I think what we all learned was a massive degree of humility, because there were so many things that we thought were obvious that actually things just turned out to be completely the opposite. And I wonder if this year we should have the same approach to monetary policy. As a monetary policy official, do you have to sit here and say, actually, the prudent way to do things is actually to move slowly and work things out meeting by meeting? Because that's what I hear from other members of the committee. And I'm wondering why you see things so differently.
Sure. So first of all, I'll say that I was right about inflation coming out of the pandemic. And if you sort of go back to 2020, when I was in the Treasury Department, we were arguing for a smaller stimulus package because we didn't see COVID as a similar type of recession that we had post-GFC, post-dot-com bubble, where you had persistent deleveraging dragging on demand that caused a balance sheet recession with a persistent, slow, crappy recovery, right? COVID was like a switch turned off, right? People stayed home, and the switch turned on when they started going out again. And so there wasn't going to be that slow recovery. And that's why we were pushing for smaller stimulus packages, because we didn't think that it merited that type of package. We were concerned about inflation picking up. So I did get that right. And I do understand the value of being cautious and having humility in these things. I will say my forecast, as I said before, is predicated upon shelter inflation. And shelter is a weird thing where market rents give us a window into the path of measured inflation that's very different than other sections of the inflation index. We know that market rents, a weighted average of single-family, multifamily market rents, have been growing at a 1% rate for 2 years now. We know that average tenant rents have caught up to new tenant rents, right? right? There are statistically mechanical relationships that give you a lot of confidence that measured shelter inflation is going to come down a lot, right? You don't have that type of confidence when you're talking about goods. I said before, I don't know what's driving goods inflation, right? I don't have this forecast that goods inflation is going to come down because it's just driven by tariffs that my colleagues seem to have, right? I don't have that type of confidence on areas of the index that I think are much more difficult to understand. Shelter is a mechanical thing from market rents to measured inflation, and therefore it's in my mind appropriate to have that high degree of confidence. And to Lisa's point, where would I be wrong? If the market rents pick up again. If the market rents pick up, then I'm going to say my mechanical pass-through from market rents into measured shelter inflation is getting invalidated, and we'll see that.
Just to hone in a little bit on the housing aspect, since that has been a really hot topic, how much signal would you take if you did start cutting more aggressively at the Federal Reserve and 10-year yields rose, and that actually created an issue for mortgage rates and the pass-through there? It might actually help with the disinflation, but it might not exactly be the outcome that you're looking for.
Yeah, so this is an area where I'd want to not jump to conclusions, because I'd want to sort of try and analyze it very carefully and think about what the market is saying, think about what the economy is doing. And if it's the case that you cut rates and you sort of get a burst of activity in some sector of the economy that's not housing, and that ends up crowding out housing, then you wouldn't really mind. You're focused on aggregates. You're focused on inflation, on aggregate inflation. You're focused on aggregate unemployment, right? If it looks like you cut rates and the bond market is giving you a very clear signal, and I'm not just talking about trading behavior for a week, I'm talking about a very clear signal over the course of a period of time that it's not the right move, then I think, you want to take that signal and you want to think about, what's the market telling me that I missed? Is the market right? Am I wrong? Let me rethink my framework.
You're going to miss this when it's all over. It feels like you're enjoying this. Are you going to miss this when you have to leave the Federal Reserve?
That's not part of my forecast.
Are you going to hang around?
Oh, I have no idea. We'll see. I don't make personnel decisions.
Okay. You've heard nothing at all from anybody?
I think that we're very clearly now getting into the new year, and the president has said in the past that he would make announcements as we got there. So,
okay.
I imagine we'll be getting some at some point, but I don't know anything about my future, so I wouldn't mind it.
Stay with us. More Bloomberg surveillance coming up after this. We begin this hour with stocks continuing to pull back from all-time highs. Seema Shah of Principal Asset Management seeing upside ahead, writing widespread fiscal stimulus, monetary normalization, accelerating AI-driven capex and adoption are all factors that should underpin robust growth. Seema joins us now for more. Seema, they're the kind of structural, big-picture stories for the next 12, 24 months or so. Let's talk about the last 12, 24 hours. Seema, we're pushing back on executive pay, on capital returns. These are things you wouldn't typically associate with the United States, certainly wouldn't typically associate them with the Republican Party. As you sit there in London and your investors think about allocating capital to the United States, does it give you pause?
Well, hi, John. I think it does to some extent. I mean, any time that you have government intervention, it typically does put off investors, obviously by varying amounts. There are some things that he said there which I think they don't necessarily add up. I mean, in terms of putting off investors from corporate housing, you almost need them there to encourage greater supply, which would be your best way of resolving affordability issues. And then even on the defense side, trying to put off the investment is hardly going to be conducive to some of the things that he's saying. The other thing about this as well is that coming into 2026, there's obviously been a lot of optimism. One of the things that's been on people's assumptions is that policy upheaval, volatility is going to be a little bit less than what we had last year. And of course, as you said, the last 48 hours suggests the exact opposite. So I think that there's some things in here which may not have immediate impact, but certainly from an investor standpoint, this is a moment of pause that maybe 2026 is not going to be as smooth as a lot of people are anticipating.
Well, Seema, let's just reflect on the last 12 months. So earnings have been great. Payroll growth has been absolutely terrible. And investors have been okay with that because earnings have been great and the equity market's been hitting all-time highs. At the same time, consumer sentiment has been rock bottom. Now, if you're a politician, to address the consumer sentiment issues, you might have to introduce policies that aren't going to be favourable for the kind of things that have driven us to all-time highs in the equity market, the kind of things that have driven a long-term bull market in the United States. Seema, do we have to think about those issues a little bit more going into the midterms and beyond? That for a whole generation of individuals that haven't participated in this run-up in the equity market, they're voting for this stuff. And they're going to keep voting for this stuff. And it's the kind of stuff that's not going to be favourable for risk assets.
It is. I think it's some of those pockets. So it's a question of how much does that impact the aggregate. So, as you said, to your point, affordability is going to be the buzzword. It has been for the last month or two. It's likely to continue. How could we see that playing out? Well, there's obviously the couple of policies around a tariff dividend. There's also the idea about maybe potentially lowering some of the tariffs that are impacting some of the lower income households the most. Now, those things, ideally, if we think that through, if they can get passed, and that would suggest that you could see some upside for consumer discretionary. But ultimately, because of the K-shape, but mainly because the top 10% really do account for around half of US consumer spending, it doesn't necessarily move the needle. What we want to see is a constructive economic backdrop where earnings can continue to do well. And it's important that those policies, and at the moment it doesn't look like it will be, but as long as those policies are not going to be impacting the earnings growth for a lot of these companies that we're focusing on.
This is the reason why, Seema, so many people have looked past some of the volatility and at least headlines coming from Washington, D.C. There is one aspect, though, that has remained relatively unnoticed, at least with respect to bond markets, and that is you can expect an expansion of the fiscal deficit possibly quite considerably, especially if anything even close to what the president is proposing relating to the government, relating to the military comes to pass. Why do you think that's not shaking up fixed income markets in any material way?
Well, I think at the moment, one of the considerations is that a lot of this won't get passed through Congress, that there's enough, I wouldn't say fiscal discipline or considerable concern, but there's enough of a pushback that a lot of this won't come to pass. But I think that you're absolutely right in saying that this is a key risk. When we're looking at the equity market, we feel pretty positive about the macro backdrop and earnings. The one caveat to this, though, is that bond yields have to stay fairly well behaved. You cannot see a very significant sell-off against this backdrop. I mean, ultimately for this year, what we're expecting is that equity returns won't be driven by multiple expansion. They have to come from earnings. And any significant increase in interest rates, bond yields, could be a real hurdle for the expectations of I guess, low double-digit returns that we have.
Well, I guess to build on that, we've just seen the fastest start to a year for corporate and government bond issuance ever. We have seen $260 billion worth of sales from these entities over just the first few trading days. And I just wonder at what point you start to get real pushback from debt markets that are saying, what are we funding exactly? Is there sort of a blank check that we're offering to governments and corporations to just build to nowhere?
Coming into 2026, I think everyone's, concerned about the debt load, as they have been for many, many years. And the assumption has been that 2026 is not the year when this is going to come to a head. As long as the macro is okay, as long as the economy is doing okay, the Fed is cutting rates, then the issuance is something that companies can continue to absorb. But of course, there is a time limit to that. Now, we don't know when that's going to be. But at least just looking at the economics behind everything, which is driving the market, we do feel fairly sanguine about that. We're hoping it's a 2027 story, not a 26 story.
Seema, as a global strategist, when you see what the president is doing, the state intervention really in full swing when it comes to the United States right now, do you expect this to be a theme this year for more industries, not just ones that are critical for national security?
Well, I think that interventionist is, as you said, it potentially isn't about just national security. I think, as I said before, I think affordability is really key, which is why we're hearing so much about housing. Maybe intervention or at least pushing back from companies, or at least stopping them from passing on some of the tariff increases. I think those are all things that we could anticipate for 2026. And I think as an international investor, one of the things that we do here in Europe and across Asia is these concerns about the US outlook is one of the reasons why you are seeing this global diversification trade just gaining more and more momentum. People really starting to look outside of the US and also recognizing the fundamental strengths that exist in other countries. I don't think that we're looking at a kind of a flood of movement away from the US, but I think it does just add to the attractiveness for other markets.
How seriously do you take some of the president's statements? Because I'm thinking of just housing itself. He even said, I will call on Congress to codify it. This has to be legislation that goes through the House of Representatives and the Senate, not policy by truth.
Yeah, you're going to have to take everything with a pinch of salt. And I think, the reason that we're not seeing the bond market react is because there is this belief that it's not going to get through Congress. So these are very popular words. Some of it inevitably, I think, will trickle through. But we're not expecting an avalanche of policy moves, but a lot of policy rhetoric should be expected ahead of the midterms.
Stay with us. More Bloomberg surveillance coming up after this. Apollo Global Management President Jim Zelter writing the following: 26 US outlook is consistent with a stagflationary environment, and we expect interest rates to be higher for longer. Jim joins us now for more. Jim, good morning.
Good morning, John. How are you? Happy New Year.
I'm well. It's good to see you. I want to pick up on this headline from our friends over at the FT in the last month. Apollo's cutting risk and stockpiling cash. Is that true? What are you guys up to?
Well, I would say that we've always been known as a disciplined investor. We talk about purchase price matters. We talk about alignment with our investors. And I think that what that statement is, it's really about the gauntlet for approving investments at Apollo has gotten higher and higher over the last year or so, as we see an environment that down the fairway, I'll use a golf analogy, down the fairway, you've got a lot of great things going on. Massive CapEx cycle, good economic growth, consumer in solid shape, a variety of great attributes. That being said, the rough, where there's lots of challenges, between geopolitics, between the concern about inflation, between the concern about the return of invested capital in AI, there's a variety of left tail items that have certainly grown in stature. As I listen to some of the macro commentary here, I think there's a great deal of humility about the macro view of how the predictions, as I've said here many times, we sat here after SVB, we all thought massive capital slowdown and spending and credit crisis. The U.S. economy really was massively resilient. You guys talked earlier about what's going on with the deficit. I think it's a little bit, it's the economy stupid. The U.S. economy, people just don't want to short the great momentum of what's going on. And we have an administration that's very politically savvy about populist topics. He's been very responsive. But I just back to the question you had, we're putting money to work. This week was a busy week. We announced $6 billion of deals, of transactions, all great companies. Again, we're leaning into larger companies that are part of the global industrial renaissance. One with Brad Jacobs, a 35-year winner in the building product space. The second one with Russell Investments, really simplifying their capital structure. And then the last transaction was very interesting, actually. It was for Valor XAI. It was really a sale leaseback on a massive amount, $5 billion of NVIDIA chips. So all three really interesting transactions, but really well structured, downside risk. And I think that's our view right now. We want to be investing capital, but you got to acknowledge you can wake up on a Saturday morning and see us with activities around the globe that really enhances the tail risk of geopolitics. You can get a stroke of the pen announcement yesterday with regard to housing. And so I think you have to be very, very careful about how you invest long term at scale.
To extend the analogy, though, to your point, the fairway is getting narrower, the rough is getting deeper. In the last few years, it's not been that way. Allocate to risk and you'll perform, you'll do well. It feels like a tougher environment.
The analogy for golf, for those who play a lot of golf, is we're at the U.S. Open. The U.S. Open is known for tight fairways and really punitive rough. And if you cape in the fairway, you're going to be a great victor and you're going to have great success. I think there's going to be, as last year will remind us, you can have some bumps in the road during the course of the year that definitely change the trajectory on liquidity, on momentum, on risk appetite. So, but I think the long-term trend is quite positive, but I do think you have to be very measured about how you execute your business model.
So if that's the U.S. Cup, do you go to the Ryder Cup?
Oh, Bramo,
I'm sorry.
US Open, there you go.
No, I mean, the idea, do you expand your, I Googled that, and evidently I bombed it, but I just am curious if you go overseas, because to diversify away from the United States.
Well, we've been, I would say to account that, we've been very vocal, and I've been vocal on this program time about Europe. When you look at the needs of governments around the globe, especially in Europe, in Germany in particular, and so more so in the UK, the government's demand for capital far outweighs their ability to participate. And so we want to be part of that renaissance in that part of the globe. In places like Japan and Australia, we want to be part of the retirement solutions and some of the global industrial renaissance with a changing banking system. We're not broadly speaking, a developing and emerging markets investor. So while we have a view on what's going on in Latin America today, that's a negligible part of our capital. That's just not what we do. We're really a G7 and larger economy investor.
So you were talking about how you're getting more conservative. Yet corporations and governments are tapping the market at a record pace so far this year. About $260 billion of bond issuance from governments and corporations around the world have been issued, the fastest pace ever.
Yeah.
Is this because there is a lot of optimism out there, or is this because they see a small window that could close and they want to get in?
I don't think it's a small window. When you look at the numbers that have been put out by the large financial institutions, the big banks, about net issuance in the IG market, it's north of it's anywhere from 800 billion to $1 trillion net issuance, which is one of the largest numbers in the last 10 to 15 years. Same can be said in the high yield and the leveraged loan market. The net issuance is going to be quite high. So with real rates and real yields fairly high on a historic basis, with a variety of pensioners and investors around the globe looking for long duration yield, it's a pretty powerful mix of supply and demand in terms of taking that overhang, if you will. I think one of the big questions is, does the equity new issue IPO calendar actually come to fruition? And the second thing that people aren't talking about is where oil is right now, it's very deflationary. If it were to stay at these levels or even go lower, again, we're talking about all the things that can go wrong. I'm a credit guy. Bonds don't go to 200; they go to zero. I'm cautious by definition. But in oil at these levels on WTI at 56, 57, that's very deflationary and very positive for economic growth. So, again, I think that there's a variety of balancing acts here going on. But to John's first question, I would say that we think that there's a variety of issues that one needs to deal with, but at the same time, you want to be putting money to work in large scale. Now, if you look at the traditional high yield market, the CCC LBO buyout, that activity is just not happening in scale anymore. It's being funded in private credit, which I'm sure we'll talk about because of our big white paper in December. But at the end of the day, it's really about credit and the ability for this IPO calendar to come to fruition.
Let's build on some of this, Jim, because I can tell you sort of openly and honestly what I've struggled with. I don't know what to look at anymore. Payrolls has been a bit of a head fake in the last 12 months. We've seen a real deceleration in payrolls growth, but it's not been relevant to the performance of risk assets more broadly. Yeah. Something that you and the team have talked about for a number of years now. When we saw interest rates go to 4%, pushing 5%, Lisa and I were talking about this for the best part of 12 months. How on earth is this economy going to deal with 4 to 5% interest rates? And we dealt with that just about okay. What should we be focused on?
So I think, I think to answer that question, it's really, we talk about the changing backdrop of market structure. The reality is in the U.S. today, it's been an extended credit cycle. It's harder to have a real economic recession because of the diversity of funding across the board. We have the healthiest banks in the globe. We have a securitization market that's alive and well in record size of issuance. That disperses a lot of risk around the economy in terms of balance sheets. You have a consumer in pretty good shape. You have a housing market where 40% of folks don't have a mortgage. I'm not saying we're not going to have an economic cycle. We will have an economic cycle. We will have a credit cycle. But if the post-SVB environment is any lesson to us all, because of the advances and the evolution of the U.S. economy since the GFC, it's a lot harder to push over this machine than it had been in the past. The transmission mechanism of the Fed that used to be instantaneous is not what it used to be. We saw it in the last 2 years with housing in the U.S. Because of the 30-year mortgage concept or the lack of a mortgage versus countries like the UK, where most folks are on a 5 or 7 year floating rate mortgage, that has an immediate impact on the brakes of the consumer and the economy. Not the case in the US. So the strength, the breadth of market structure, how companies finance, the role of banking, the ability for the Fed to actually have that transmission mechanism of raising rates and slowing the economy down, it's not what it used to be. It's not your father's economy.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.